Welcome to Growth Investing Mastery. This video is going to look at AppLovin's Q1 2025 earnings. As a reminder, this is not investment advice or recommendations to buy any stocks. AppLovin is an ad tech product for mobile games, and they're expanding to e-commerce and web. Let's jump right into what AppLovin guided for Q1. The company guided revenue to be between 1.355 and 1.385 billion. Adjusted EBITDA was given a range of 855 to 885 million, and adjusted EBITDA margin was projected to come in between 63% and 64%. Taking a look at analyst estimates, they projected that revenue would be 1.379 billion and adjusted EBITDA would be 867 million. Let's take a look at the actual results for AppLovin's Q1. Revenue came in at 1.484 billion, which was up 40% year over year. Adjusted EBITDA was 1,005 million, or slightly over $1 billion, and that was up 83% year over year. EBITDA margin came in at a stunning 68%, which is a massive beat when the company was guiding from 63 to 64% on EBITDA margin. We can see that the company beat their revenue guidance by about 8 or 9%, but they beat their EBITDA guidance by over 10%, and it shows how profitable this business is. Now let's look at the new guidance AppLovin gave for Q2. The company started guiding this quarter to advertising only, as they're selling off the apps or games portion of their business. For Q2 of 2025, the company is guiding revenue from 1.195 billion to 1.215 billion. Adjusted EBITDA is given a range of 970 to 990 million, and adjusted EBITDA margin is projected at 81%. Looking at current Q1 advertising only revenue, it was 1.159 billion, so projecting 1.215 billion is a significant step up. Additionally, adjusted EBITDA for advertising only in Q1 was 943 million, and that's projected to go up to 990 million in Q2 at the top end of the range. Over the last few quarters, AppLovin was typically projecting the run rate revenue and run rate EBITDA for the next quarter. So this is a significant step up on their guidance. Let's get into some more numbers that AppLovin reported in Q1. Net cash from operating activities was 832 million. Free cash flow for the quarter was 826 million, which was up 113% year over year and 19% quarter over quarter. The company also repurchased 1.2 billion worth of shares in the quarter. The company's metrics for spending are coming down, as cost of revenue this quarter was 271 million versus 294 million last year. Sales and marketing in the quarter was 183 million versus 227 million last year, and R&D came in at 123 million versus 155 million last year. The only metric which was up on the spending side was G&A, which was 55 million versus 42 million last year. So you can see the company needs some more administrative staff, but otherwise they're reducing their costs around the board. Management gives a custom metric of run rate adjusted EBITDA per employee in the ad business, and that came in at 4 million per employee. There was a 600 basis point increase in adjusted EBITDA margin quarter over quarter. Additionally, GAAP EBITDA margin went from 53.7% in Q4 to 62.8% in Q1, up almost 900 basis points. It's really crazy to see that a company the size and scale of AppLovin is able to increase their EBITDA margin so significantly. They mentioned there was an 82% flow through from EBITDA to free cash flow. Additionally, management gave this stunning statement that quarter over quarter flow through from revenue to adjusted EBITDA was an exceptional 104%. They did mention it got over 100% due to non-recurring costs, but adjusting the metric, flow-through was still a robust 100%. These numbers are hard to make sense of because earnings is higher than revenue. However, it essentially means their product is free to run and almost all revenue turns into earnings. Now let's look at some aspects of the Q1 narrative that AppLovin told. They are selling their apps business for $400 million to Triple Dot Studios, and they're taking a 20% equity stake in that company. I actually thought they may be able to sell their games business for a bit more than $400 million, because the games business was producing about $70 million of adjusted EBITDA per quarter, but I'm okay that they're going to sell it for this amount and get some equity. Management mentioned our partners' vocal support this quarter was inspiring, and they had outstanding Q1 performance. It's great to see their customers are enthusiastic about AppLovin products. Management is focused on 3 key priorities right now: improving models, advancing e-commerce and web, and enhancing ad testing with automated creation. The self-service dashboard for the e-commerce pilot will be launching this quarter for select customers, and the company is enhancing third-party platforms and attribution vendors, working within the ecosystem of the ad space. The CEO said that launching self-service globally will unlock a massive opportunity. He also mentioned that mobile games are not directly impacted by tariffs. However, some of their developers may be impacted by tariffs on the individual side. The potential changes to the App Store where they reduce their fee are seen as a positive by AppLovin management, and they said that developers with more money is a good thing, as they can spend more on ads and promote their games more. There is a strong flywheel effect with AppLovin's business. More impressions leads to more engagement, which leads to more conversions. And generally, the company is seeing a lot of excitement from advertisers on their platform. Let's continue looking at some aspects of the narrative for AppLovin's Q1. The new dashboard is gaining feedback from existing customers. There will be a huge catalyzing effect, management said, when the dashboard goes full self-service and the e-commerce pilot is available globally. They will be opening the platform from select advertisers to the entire world. And a direct quote was, "We've got a line out the door of customers that have been waiting to come onto the platform." Currently, the web algorithm is not as advanced as the games algorithm, but the web algorithm is performing better than management expected. The web pilot has just a sub 3% churn rate. However, management said that's still not acceptable. In gaming, there's effectively no churn, and the CEO said, "Companies in gaming do not drop off our platform. We're basically a requirement to their success." AppLovin did not expand the pilot heavily beyond its initial 600 customers, because the team managing the project is just 20 people. The objective now is on the self-service dashboard, as that will unlock the global opportunity for advertisers worldwide. Taking a look at some more narrative details from Q1, AppLovin constrained the web advertising audience to be US-based only. The engineering team launched model enhancements in the quarter, and this created step function increases in profitability. The CEO said that, "I don't know of any other tech company with the financial profile that we have and scale growing the way we are. I think it's on a rule of 150 or something." And there he's almost mocking the rule of 40 because AppLovin's business is so far superior to other SaaS-based companies. The self-service dashboard is going to have many quarters and years ahead of it of immense growth, management said. And they're on the cutting edge of algorithm implementation, where they view all the latest research in AI and algorithm development. The reality is, it's really, really early, management said. They reiterated that the team found wins in improving model efficiency in the quarter. Adding the e-commerce demand and supply to the platform improves the product because it's not just gaming ads anymore. It's a whole wide variety of ads now. The system will catalyze potentially years and decade plus of growth, management said. And that's pretty interesting. Management is talking about a decade or more of growth from this product. So you can see how big their vision is for this product. One analyst asked about TikTok, and the CEO said that pairing their audience could unlock immense economic potential. However, that deal seems like it's on hold for now. Let's summarize what we've learned about the Q1 2025 AppLovin earnings report. The stellar outperformance was driven primarily by gaming still. While e-commerce is ramping up, it didn't make up a huge portion of the revenue just yet. The e-commerce and web presents tremendous upside for the company, and management gave stronger guidance than they typically do. The costs for the business are going down while profitability is going up. And the 600 basis points quarter-over-quarter increase in adjusted EBITDA margin is just crazy. And on a GAAP basis, it was almost 900 basis points. So you can see how much profitability is really ramping up on this company. The business sounds like it has a lot of room to scale up still. The self-service automation could unlock never-seen-before scale in the ad tech business. And I would finally add the numbers back up the CEO's hype on this story. He's talking a big game about a decade worth of growth, but the numbers are really impressive, so I have every reason to believe him. And my action plan is just to hold AppLovin. It's already in my top confidence position, and with this recent run-up on the price, it's become an even higher allocation, but I'm happy to keep it where it is with the impressive results they just delivered. This concludes the video on AppLovin's Q1 2025 earnings review. As a reminder, this is not investment advice or recommendations to buy AppLovin or any other stocks. If you enjoyed the video, leave me a like or a comment below. Thank you.